Perfection. Okay, great. Now we're back in action. So let me reshare my screen and we'll pick up. Okay, so non-QM, again, outside the box mortgages that fall outside of the normal Fannie Mae, Freddie Mac, Jumbo, FHA, VA, blah, blah, blah. Okay. So these are some of the programs that we're going to talk about today and who they are, who they would be for. And guys, just know we'll send this PowerPoint over to you because there's going to be some, fairly data-driven stuff in here. So you'll want to have access to it. Okay, so a lot of these programs are our branded products, which means we've got them serviced by us, basically, and we've got an end investor that's buying them, but the servicing is us. So we mask them as different, cross-country mortgage, signature, expanded, blah, 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 type stuff. So first one is a signature expanded bank statement. This one is pretty standard. Basically, it's allowing people that are self-employed to use bank statements instead of tax returns. So obviously this exists because what do we know of people that are self-employed? They write everything off, right? So they don't have to pay tax on it. I used to always say, hey, you don't pay the government the tax, you don't get premier, loans. So now we're a little bit different because there are other ways, because there are lots of, official loopholes in our tax code that allows that. So basically what we're doing is we're looking at their bank statements and seeing over a 12-month period or a 24-month period, the deposits into their account. We are averaging those deposits and that's what we're using for income. Okay, so it's a different way. So we've all had those self-employed people that they make about $1 million in gross receipts, but they've got every write-off under the sun. But when we look at their bank statements, we can see every month, chunks of money are coming in. That's what this program is for. Okay. So over here, it's just got highlights. Max loan to value will go up to 90%, credit score 620, amortization. We've got 30, 15, 40 is an amortization. It's not a typo. I don't like it. There's a premium to have a 40-year mortgage. So stick with the basics. They're not as expensive. Loan amounts 100 to 3 million. So this covers the gamut. So in our normal world of thinking, we've got the conventional mortgage limit, which is, sorry, it's never a normal number, 766,500. You're $1 over that, you go into jumbo. These are more of the programs that the client needs. It's not driven by a loan amount and then you go into this category or this category. It's 100 to 3 million. Okay. Max DTI 50. Okay. Next one, asset expanded qualifier. So what is it? This is basically where a client can use their assets to qualify in lieu of income. Okay. So these are higher net worth borrowers that are looking for easier financing options, meaning, gosh, I just sold a company. I've got a windfall of cash, but technically I don't have any income. So we will look at their assets, their age, do a factor, and then come up with a monthly income that we then can utilize. Okay. There's no liquidation. They don't have to do anything funky. It's just all the assets are over here. And we also have this program with Fannie Mae and Freddie Mac. The difference is that those assets have to be in a non-qualified retirement account, and the client has to be a certain age. And I want to say it's 55 in order for us to use that. We can they have to do one distribution and we can basically set it at whatever. And that's the income that we're going to use to qualify. This is different. This is any age, and it doesn't have to be in a specific non-qualified retirement. As you see, eligible assets are checking, savings, securities, crypto, CDs, anything. Okay, so that is a very different kind of program, but it does work. A lot of times we've used it on, we had a client that sold a business and got, basically a payout for 3 years. So we got a huge chunk, and then every year he got a payout, but he really wasn't getting a paycheck on a monthly basis. So we really didn't have any income per se. We use this program and worked easily. Okay, so kind of same parameters. We'll go up to 10% down on this. Again, loan amount's going to cover the gamut, 100 to 3 million. Next one. This one is very big for investors. So if you ever have clients that are strictly investors and they may write off every single thing on their tax return because they're depreciating properties and whatnot. This is a great way for an investor to buy a home without us ever even looking at their tax returns. And it simply looks at the cash flow of the property. So this is called the debt service coverage ratio. So DSCR loan is what we call it. And basically the way that it works is if there's $3,000 in rent on a property and their monthly payment is $3,000, that works because it's 100% of what the rent is and what the payment is or less. Okay, so this loan, if you look in how does it work, the DSCR can't be lower than 0.75, which means the rent cannot be lower than 25% of what the total payment is. Okay, so let me know if you've got questions on that, but it's a calculation that we will look at. And that way we don't have to look at any of their personal tax returns, nothing. Okay, this also can be used for Airbnb. So Airbnb can be a little bit more challenging, but if there's an Airbnb or, the AirDNA software, we can use those softwares to see what has this Airbnb done in the past, what are its potentials, and we can use that in order to qualify them. Okay. Does this have to be? No, it does not have to be purchased in an entity, meaning an LLC or something like that. It can be owned personally, or it can be purchased in an LLC, whatever the client prefers. Okay. So who benefits from this? It's basically the mom and pop investors that typically want to hold on to things longer term. They don't necessarily want to flip, but maybe on paper, because they write everything off, buying another investment property would not cash flow for them or would not look good for them. Okay. So again, cannot be a first-time buyer, cannot be a first-time investor on this program. They have to have at least one investment property under their belt in order to use this. Max DTI, that's the best thing ever, right? None, because we're going off the rent versus payment. So there's no DTI calculation whatsoever. Next one. This is our signature expanded full doc. So this is really where you've got a conforming client, meaning, everything's, they can do everything, they can document everything, but they're just kind of falling out of something qualifying wise, and we can't quite get them to go into the Fannie Mae, Freddie Mac, or the jumbo, like, the Citibank or the Wells or whatever. Okay. So in this one, all the traditional stuff applies. Okay. So W-2s, tax returns, etc. So again, this might be a little bit more about the person. So DACA. So those are people that were, they have a family that was immigrated here, and they have not gone through the process of citizenship, but they are kind of grandfathered in, or because they've been here basically their whole life. People that are using ITIN. So if we've got people that don't have a social security number, but they have a tax ID number, those folks will work here. Lacking credit history. They might have a W-2, but maybe they don't have any credit, or they've only got one trade line of credit. If they've got properties that are outside the norm, bigger acreage, non-warrantable condos. Now ADUs we have on here, but Fannie and Freddie have recently given us verbiage and the go-ahead to have properties with ADUs. So that's a change. So that probably will fall out of this category now and go into more of a Fannie Freddie world. Okay, so these are something where the client pretty much qualifies. It's just there might be something about the, oopsie, sorry guys, might just be something about the property, or maybe something a little bit about them that they just can't quite qualify within the lines now. Okay, so just outside. Next one. I'm trying to think of like if there's situations where we've had things. This one, we've done quite a few non-warrantable condos on this. Non-warrantable condos, the insurance thing is a big thing. If you are selling a condo, please do yourself a favor and make sure that the association has at least a 5% deductible or less. Okay, if it's not at least that, and let's say there's an 8% deductible and it's not on the Fannie or Freddie already approved list, that will automatically take your condo out of being warrantable by Fannie or Freddie. Again, that's the only thing. The client can be pristine, but when we're looking at properties, it's got to be the property and it's got to be the client. They're a package deal. Okay. Foreign national. So this isn't as big here. But in Florida, we have a lot of mortgage people in Florida. This is a very big program for them, where you've got people that live abroad that want to buy investment properties in the US, and they're not citizens, but they've got income. So, or maybe they've got foreign income, or excuse me, they live in another country. They can use this program to buy here in the US. They're not citizens, they qualify, but they want to invest here. This is very big in our Florida market, in our New York market. We don't use it a ton here, but it's nice to be able to utilize this. They also can do, obviously, the DSCR or the asset qualifier programs, because most of these people are buying investment properties. Some of them are buying second homes, then they would fall into this one. Okay, a little bit more money down than some of the previous ones, but in general, you know, or Fannie, Freddie, Jumbo, all citizens. So we need something else. This is our program for expanded signature. So this one basically allows us to utilize people that get 1099s, but don't necessarily want to show us their tax returns. Okay, so again, we're back to the tax returns. You can write off lots of things, but a 1099, if you're a consultant, contractor, you get that income and it's being paid to you by another party. We can validate you received it, but maybe you write off a lot of things or don't want to show your tax returns. This is another way to buy, where we can just look at your 1099s and we're going to use them like a W-2. Okay, so doesn't require tax returns. We use the 1099s like a W-2. We do have to have at least 1 year, prefer 2 years, because we'll always average them, but we can get away with 1 year if you've been in business for at least 5 years, or been a contract worker, been a real estate agent, then something where you've gotten this 1099. Okay. So again, a lot of the same parameters. We don't care, you know, loan amounts, 150 to $1 million, max debt to income, 10% down, credit score. This one, it's just our signature expanded ITIN number, our ITIN program. Again, this is where we are utilizing people that maybe don't have social security number. They're not citizens, but they have qualified visas, but they have an ITIN number. So that way we can utilize this program in order for them to buy here. Again, we don't have a ton of these, but we definitely have some people that are kind of waiting for their visas and they've got a good visa, but they don't have a social security number. So we'll use their ITIN number, which works for this program. Fannie and Freddie, it would not. This one, so mixed use property. Again, if you've got a bunch of outbuildings where the outbuildings may exceed the value of the residence, these are the ones where we will use this, because Fannie Mae, you have to have the primary residence be valued more, and the outbuildings can only have a certain percentage of value when we're looking at a primary residence. So this will take different properties that maybe someone runs a business on it and they've got bigger, buildings, and they've got some mixed use that they're using it not only for their primary residence, but maybe they run a dog kennel out of it. We've had that one before. So again, just different where there's a business or something else that's adding value, that it's not just the primary residence. We got to look at kind of the whole package. Okay. I will keep moving. So I think what's also interesting is because a lot of these products are serviced by us, there's a lot of exceptions that get asked to get done. And these are just some of the most common exceptions that we've made in the past. Having landlord history. If they're buying for the first time and they want to use the 1099 program, typically we want to see that they've been paying rent for a year, but they might have been living with family, or they might not be able to prove the rent because they did the groceries versus the rent. So these are some of the exceptions that have been made on these programs, because these are our most nimble. Okay. So again, just something for you guys to see what options are, say, hey, we've got this, but we don't have this. Those kind of things. I always think that's helpful because, until we're doing it, we don't know what the tolerance or the limitations are of the programs. That I'm skipping. This I'm skipping, that I'm skipping. We do have a bunch of co-branded stuff. The other thing that I wanted to make sure that I touched on, this is my own add-on because corporate doesn't have it at this point. Right now, we have a guaranteed offer that allows clients to be non-contingent. So what is it? It allows clients to be non-contingent if they can't qualify in the traditional way to be contingent. Why does it exist? I think one of the biggest challenges right now is that prices of homes are expensive. Rates are expensive. It's not always easy for people to qualify to purchase their next home with being non-contingent and still having their departure home. And they're nervous about jumping to that next home relinquishing this home without knowing what their next home is going to look like, if they can find something, etc. So this allows them to get a guaranteed offer from us on their departure residence. And once we do that guaranteed offer, that home then has all the contingencies removed. And that's when our client can then make a non-contingent offer, because Fannie Mae and Freddie Mac says that if you've got a offer on a departure residence and all contingencies are removed, you no longer have to add that property into the debt ratio. So that's how this program works. Okay. Now, departure home is reviewed. So we're going to look at the departure home first. We're also probably going to do a bridge loan because we want to access the equity if they need it for their down payment. So if we're doing a bridge loan, we're gonna do that because our guaranteed offer is going to cover the first mortgage and the second mortgage or the bridge that we do. Therefore, both of those loans, we do not have to use them in the debt ratio. So we've got an offer that we'll make on the departure home. So let's say that you're wanting to, market value is 400. We may say, we're gonna give you 390 for it. But here's the thing, you've got 4 months to sell it on your own before we're gonna come in and buy it. Okay, so 90% of the time, we're never gonna buy it, that you're going to sell it before that happens. But it allows them to make an offer on the new home, close on it, get settled, and sell this one. Now, here's the caveat. I'm going to be crystal clear. This one is not cheap. It is expensive, in my opinion. So I have this one. I just did it for a client. They were selling at basically 380. So the cost to them to do this program was 5,800. They were like, oh, we do not want to pay 5,800 to do this. However, when they looked at the options of selling first and kind of not knowing what they were gonna get, relocating 3 kids under the age of 8, doing potential temp housing because they didn't have family that they could live with. When they kind of getting storage, when they looked at those options versus this ended up to be a better option and more cost effective when they added up and did all of that research. So it does work for the right people, but it's not cheap. So I want to be really clear on that. So who benefits? For clients that can't qualify non-contingent and don't want to sell without knowing what's next. Okay. And then the last one, if I can scoot it down. And I might have to stop sharing for a second because I am clearly technically challenged on pulling it up. There we go. I'm going to go back to sharing. All right. And our last option is a cash purchase on the new home. So what is it? Clients can make a cash offer with us and then reserve the right to finance. So basically why we made this program, and this one's brand new, basically it removes all contingencies. So if someone wants to make a cash offer, they have that ability with 0 contingencies, no inspection, no appraisal, no anything. Okay. So basically how it works is this. We've got a property that's identified. So here's the catch. Let's say Jen, because she's the only one I can see, I'm going to pick on her. Let's say we've got a client that's going out this weekend and there's 3 addresses that they're interested in. I want all 3 of those addresses because what we'll do is we'll identify the max cash offer on each one of those addresses. That way, if the client says, I want to make an offer with a cash offer, we're ready. Here's the caveat. Every program has its downfalls. The max cash offer may not be enough to win. Okay, that's the problem here. So let's say it's listed for 400. We may say max cash offers 420. And so if you get into a bidding war, you may lose because the cash offer may not be that high and because we're removing all the contingencies. So that can be a little bit challenging here. So max cash offer, offers made with cash, offer accepted, then virtually we move quickly to do financing because the goal is not for us to pay cash for this. It's really just to have cash as our backup if we have to perform with it, but it is to pop financing and get it done and move quickly. So who benefits from this? Clients that are in a really competitive offer situation and basically need no contingencies to win, but still really want financing. Okay. So this one I think is a great talking point, and I think it can be used to win. But I just worry right now with what I'm seeing so far in the market with prices being pushed a little bit, that it's going to have some limitations. So we'll see. No one for me has wanted to use it yet, so I get it. Okay, so that's kind of all of the slides and things that I wanted to talk through and that I wanted to let you guys know about. What questions do you have for me? I'm going to stop sharing so I can see people if anyone will see me. What questions do you guys have for me? What things are a surprise? What do you think you can use? Is it just like, hey, these are good things to have in our back pocket if in the, 1 out of 20 clients it comes up? Nobody? I was so.
Hey, Lisa.
So what the,
Can you hear me?
go ahead.
Go ahead.
Hi. What is the parameters or how are you guys looking at things when you're processing? Like, okay, we're going to consider how much cash. Is there an algorithm? Is there a process? Like, what are they looking at? How do they run those numbers?
Excellent question. So it's why I want the addresses beforehand. So that can take up to 24 hours. So what they're looking at is we've got to send it to our internal people. There's about 4 or 5 people that this is all they're doing. They're going to pull up what it's listed for. They're going to pull up comparables. They're going to probably run it through to kind of see, hey, what is the max, kind of appraisal before it starts to get flagged of we're uncertain that this value is sustainable if we had to have an appraisal. So that's kind of what's happening on the backside of things. So it's kind of a combination of all of those things. They're looking at the MLS, they're putting it through kind of the appraisal portal. Again, kind of like how we run it through almost like a desk review type situation. So that's how they're doing it.
And then how do they transfer or transition then into being a financed offer if they choose to do that? Or do they get to close cash and then transition it? Or how do you make that?
Excellent question. So basically what happens is with a cash offer, they want you to close no faster than 20 days. So cash offer 20 days. In that time frame, we really want to hustle and just get the financing done. But if for some odd reason we can't, or it takes us too long, or an appraisal has to be done and the appraisal's not quite to snuff, then we would close as cash. And then there is a process for us to simply transition it to the buyers with financing once we have it done.
And is there like an expense? Is it more expensive to go that route? So like if they end up having to close cash and we can't get it done as a financed option, is that more expensive for them, I would assume?
There is, I would say when I've looked at these, it will cost them about an extra 0.5% of the cost of the loan. So if they're borrowing 500, it may cost them $2,500 to do this, or it's going to cost them about 1/8 in the interest rate. They can pick and choose.
Okay.
Different than the other program.
And as far as it being a non-contingent and you're working in the background in that 20 days to try to get it closed like on a financed side of things, there really truly is no appraisal. It's just a desk appraisal. So no inspection, no appraisal, none of that stuff is happening.
When we are doing that, that is correct. The only thing that I would say is that these will require, I believe the only ones that we're doing this on, and I will double check this, is if they've got minimum 10% down, because then we can get away with some different things behind the scenes with us because we'll service it.
Okay.
The other caveat that I thought was interesting, hopefully not a game changer or anything like that, but if we do have to do it in cash, the agent does not get paid until it's transitioned to their financing. But we want it transitioned within 7 days. So hopefully that's not a delay. The listing agent would get paid right out of the gate. The buyer's agent doesn't get paid until it transitions. So just note there's a little caveat there.
Okay.
But good question. Other questions, other thoughts, other things?
With that cash program too, is there any other additional like earnest money requirements? Like, do you have to have more earnest money down, or is there like like you said, it's a minimum of 10% down is helpful, but is there other weird things to this?
They have to qualify.
That's a
No,
good way to start.
they
Yeah.
have to go through, I mean, we already do a full underwrite, so it's really not that different, but we can't fudge it,
Yeah.
meaning if it's a past client of mine and I know that I've done their loan 4 times before and I know they're good and I've seen their pay stubs, I can't fudge it. This has got to be, I got to have pay stubs, I got to have all assets, I got to have tax return, I got to have the full meal deal to
Yeah.
make sure. So that's kind of the only other caveat to it.
Cool.
Mhm.
Thank you.
And only owner occupied conventional, no FHA, no VA, no USDA, no jumbo.
Okay.
Other questions? Anything else? No? Okay, guys. That's all I've got for you. The only other program that I was like, gosh, I should have put that in. But the only other program I think that people forget about is a physician's loan. So that's the only one that kind of also is outside that camp. So physician loan for us, and I'll add it to whatever I send out. Physician loan, 0 down to $1 million. No mortgage insurance. Anything over $1 million to $1,250,000 is 5% down. $1,250,000 to $2 million, 10% down. Okay. It's for physicians. God, there's some kind of like, ophthalmologist, something, and veterinarians, which I thought was an interesting spin, but veterinarians, that they can do this program. The other big deal on this program is that, like, for example, I have a client who's using this program right now. They are closing in April. He doesn't start his new job until September. And we're using that income. So he's finishing his fellowship right now. He's finishing that in Colorado. He's relocating here, and we're using that income. And that's also really different for a physician loan, because if you were doing a jumbo loan, you would have to start within 60 days of your first payment. Conventional loan, you've got to be within 90 days of your first payment. So a physician loan really allows people to outstretch their closing before their first payment. Or excuse me, their closing before they start. Sorry. Okay. So if anyone has physicians, I think these are great programs. No mortgage insurance. I mean, wow. And interest rates are very competitive. I think that they're about 0.25% higher than market. So, and honestly, without the mortgage insurance, they're probably similar to those folks that are paying MI that have maybe 0.25% lower in rate. So there's no MI, that just adds to your payment. Okay. Okay, guys, well, let me know if there's anything else that you have questions on, or if you have any of these clients that kind of fit into these outliers, or you're just not sure. Let us know. We are happy to look at them, chat with them. I just think these programs are more and more around. And for us, the amount of these programs that we did as a company exceeded the amount of jumbo loans that we did last month. So we know there's an absolute need for them in the marketplace. We just don't talk about them a ton because I'm lazy, maybe, I don't know. Okay, guys, if there's anything else that you need from us or that we can do, please let me know. I will follow up and send out kind of the PowerPoint that I did today and the additional notes on the cash option so that you guys have it all, okay?
Thanks so much,
All
Lisa.
right. Thanks you guys for jumping on. Appreciate it. Take care. Like that.